Hey guys, welcome to Idea Drop. Michael Miller is going to piggyback off of us and use it for his episode. So today we're asking the big important questions like, should you invest in corporations that have 3 letters as their name? To kick us off, I believe we have Mr. Miller, who is an ex-banker. And, we actually have a bunch of people here. Kendall, can you just intro everybody here? Who do we have on the call?
Yeah, so for this emergency podcast, obviously SVB collapsed, and that is some drama in California, and it probably affects a lot of other things. So we pulled on General Smart People. So welcome, General Smart People. Andrew and Caleb both work with me at Miramar. They both have finance and real estate backgrounds. Caleb was actually the principal of a 9-figure fund for a while, and it was in a really weird type of asset. And I think that there's going to be lots of trickle related things from this. So I invited him. Michael, obviously you were a banker for a long time. I don't even know if we're allowed to say what bank, but one of the big 4. And you nerd out on some of this type of stuff, and it does affect the everyday person. So I think both of our podcasts and shows, are really not supposed to be aimed at the sophisticated stuff where corporate decisions are made, but actually, is this going to affect me? Should I care? Do I care? Why do I care? So I wanted to give a little summary first. Obviously, people are getting kind of fractional news from social media and whatever mainstream media is sharing, and it's not all interpretable, to be honest. So summary is Silicon Valley Bank collapsed last week. The reasons are pretty clear. It couldn't make good on the deposits that people wanted out, and people wanted out all at the same time, roughly, because it was really centralized in tech, corporate business, a lot of startup, a lot of venture capital business. 50% of all VC invested startups had their main deposits there, so it's almost 200 billion in deposits. And banks do not make money from keeping that just sitting around. So they deploy the money, and where they deployed the money wasn't liquidatable fast enough, well enough at the right price when they needed more than people were withdrawing all at the same times. And because it's pretty much the tech mafia in San Francisco, once word got around that people were nervous about that bank, it really got around. And so this one subculture got really shockingly, this bank went under really fast, and it's in receivership now. So, and then some stuff happened on Sunday over the weekend. So Michael, what happened on Sunday, and why is it important? What's the government doing?
Yeah, this one's really interesting for a lot of reasons. One of the things that happened over the weekend is Signature Bank also collapsed, was taken over by the FDIC in addition to Silicon Valley Bank. Actually, there's rumor that we may have up to 5 additional banks to follow. So it's definitely an interesting thing. Most specifically, what happened over the weekend, which, I don't think it's been marketed this way, but I would call it a nationalization of the banking system, took place over the weekend. Basically what the Biden administration did is they came in and said, hey, we're going to guarantee all of the deposits specifically from SVB and Signature Bank, which Signature Bank was largely a collapse due to cryptocurrency, which is a whole conversation we can have, I'm sure. But basically came in and said, hey, look, all of the depositors that are freaking out about how they're going to get their money, how they're going to make their payroll, how they're going to become liquid with their balances that they had in the bank, all of the depositors are going to be made whole, and the taxpayers aren't going to pay for it. And the way that we're going to do that is we're going to pull from the FDIC fund that all of the banks pay into as a part of their bank charter fee, and we're going to make all the depositors whole. Well, the problem with this is a couple of fold. One, it's absolutely a bailout. And the fact that they're saying it's not a bailout is complete idiocracy. The reason why they can't call it a bailout is because bailouts are illegal now. So what we're doing is we're calling it essentially a backing of depositors, or
an insurance policy.
Yeah, which is all good and fine, like good for the depositors. The problem is that the Fed is, in this particular case, the Fed is becoming the firemen to the arson that they already were, right? The Fed lit this fire. And so now they're putting it out out with FDIC money that's paid for by all of the banks. And by the way, if inevitably we have an issue like this again in the future, well, now we've set a precedence for what's going to happen, which essentially is a nationalization of banks. And so the regulations are going to get intense. The management's going to get intense. The big banks are not exempt from this. As a matter of fact, the big banks are going to it's going to get harder and harder for them to be profitable because the regulations are going to get ramped up on them faster and more aggressively. The small and mid-sized banks that didn't have as strong a regulations are going to get regulated to the tilt. And, if it were me and anybody listening to this, I don't know that I would be an investor in anything bank for probably the next decade, maybe ever again, because now the bank is essentially becoming an entity of the government as opposed to a private sector regulated by it. So that's my opinion and kind of summary of what's happened over the weekend. And it's a mess.
All while we slept, while we weren't even at work. It just,
it's a mess, man. It's a mess, but it's not cause for cataclysmic chaos, I don't think.
No, our society's past that for the most part.
No, are you kidding me?
We're past that. Yeah,
right.
I mean, I happen to live on a large water source and I have protein built in and I have acreage, but we're past the point where we could, anyways.
No, that, I mean, to me, that's the biggest systemic risk. And that's really what the Biden administration aimed to do, which was to reassure depositors that their money is protected and that the government's got the banking system under control.
Michael, I'm going to cut you off here really, really fast. Sorry, you probably were just getting into this, but can you just compare this in terms of magnitude to the Lehman Brothers collapse?
Well, by magnitude, it's a weekend party. The Lehman Brothers collapse was worth something to the effect of $2 trillion. I think this is worth something to the tune of $200 billion.
2 trillion what? 2 trillion what?
Dollars.
No, yeah, but what kind of dollars? Like deposits lost?
No, it wasn't deposits lost. It was
Equities.
assets lost. Yeah, equities and assets lost. This is something to the effect of 200 billion. And so by comparison, it's not even
So
close.
that's 10%, but we don't know what the trickle on effect is. So if the other ones that you said 5 more could go under. I like regional banking is like suddenly in question. It wasn't last week and now it is. And that's the scariest part for me is like a lot of business is run out of regional bank lending and relationships. And if we basically make this a top 4 bank only party, all basically ran from the government, our economy is going to get weird. It's going to get weird.
It's going to get weird, but we got here kind of honestly. I mean, the reality is that the banks were getting 0% money for the last, decade. And to raise the rates, what was it? 26 basis points in the last 12 months. Like
happened really fast. I was refinancing and then I wasn't.
Yeah. I mean, so that's what I mean when I say they're both the arson and the firemen, because the reality is that the most secure assets that these banks have are mortgage-backed securities and bonds. And as a result of this, the bond market is collapsing. I don't care what anybody says. The bond market is absolutely collapsing. It's artificially inflated momentarily, but it will collapse, which, by the way, is substantially bigger than the stock market. And nobody talks about that. So the bond market is in.
When you say collapsing, though, when you say bond market's collapsing, like that's a big.
It's absolutely
that's a big
collapsing.
thing. So you're gonna have to. You're going to have to unpack that.
Well, because, I mean, it's very, very simple. The bond market, the bond yield was at 5%, and now we have bond yield at 10%. So the 5% yield is absolutely worthless, right? Everybody's
like if you were already holding bonds that were worth 5% annually, now those assets are worth so little to you. I don't know what the discount is on that. Do you know?
Not offhand,
like
but it's substantial.
Yeah.
It's substantial.
70%, 70 cents on the dollar or something.
Yeah. And
I like how you
go ahead.
Yeah, no, I like how you said, Michael, they're both the arsonist and the fireman. And I'll just dumb this down a little bit. Now, I'm not an expert in banking, so you correct me if any of this is wrong. But for the average listener, my understanding of the why for this is that for the last decade or so, interest rates have been super low. And so the Fed sets the rates, And then the banks, so basically the interest rate's been 0%. Like you said, they've been getting 0% money. And that's why real estate mortgage rates have been roughly like 2 to 4%, because banks they basically charge a couple percentage points more than what the Fed rate is. And so in the last year or so, they've raised that, like you said, 26 basis points. Well, these banks last year or previous to that bought treasury bonds that were giving them lower interest rates, like 1%. I don't know if that's the exact number, but it was lower rates. And then now that the rates have been raised to 5, 10%, nobody's willing to
1%.
buy your
Yeah.
1% investments.
You
But
gotta
these
sell 'em at a
banks,
discount.
some of them may have been doing it somewhat responsibly because everyone says bonds are the safest thing you can buy, until the Fed decides to raise the rates by 26 basis points in 12 months, and nobody will buy your bonds because they are they're worth less than what you could just go and buy at the open market. And you
Yeah, this
combine
is
that with a bank run, and you have no liquidity, and then you have to close down. Is
Yeah,
that a correct understanding for the listeners?
essentially, I mean, and mortgage-backed securities, right? Because mortgage-backed securities are directly tied to rate. And so the most safe assets that these banks have. But the problem is that they were, what this has exposed is that they were radically under liquid, right? They had a big liquidity problem that was exposed. But the issue is that of course this happened. This is what happens when we suppress the cost of funds for so long that we allow these bad actors to go. Well, of course they're going to do this. Like, and by the way, like the funny part of this whole thing is like the COO.
Who are you calling bad actors in this? Other than the fact that
the bank managers, the C-suite.
Well,
I mean, for
SVB, they actually didn't even have a chief risk officer for the last 8 months. I don't know if you'd seen that, but since August, I think they didn't have a CRO. They just didn't have one.
of the year.
That seems asinine to me, given that it's just venture capital heaven. Like that's exactly what their biggest. Oh my god.
Well, which is also another interesting point of this, but I mean, there's so much comedy attached to this. First of all, their chief controller what was it? Their CFO. No, it's their chief controller was the former CFO of Lehman.
Lehman, yeah.
So that's hilarious. Secondarily, like all but one of the C-suite basically liquidated the lion's share of their positions before they announced their liquidity problem, which somebody's going to prison for that.
2 to 3 weeks ago.
Yeah, it's like that. There's so much about this that's laughable. But
Dustin, you look shocked.
What's
I didn't
really
know
interesting?
That, man.
Welcome to the jungle.
That is
what's really interesting to me, though, is that this didn't have to happen. That's the weird part about this deal is this didn't have to happen because SVB came to its investors on Wednesday of last week and said, we need to raise I think it was $2.5 billion in capital. And instead of getting behind shoring up their bank's balance sheet, by the way, the same bank that started all of their all their VC firms, like these VC firms were
40-year-old
started
bank
by a 40-year-old bank that backed them. And instead of helping their bank shore up their balance sheet, they sent out a clarion call to the Valley and said, get your money out, and sent off a ripple effect. That's what's interesting about this. This is actually when an industry turns on its own is really what took place here to begin with.
I mean, but it's so logical. Like if you're a VC, it is not your job to go bail out your bank. It is your job to honestly give a return to your investors. And the way that you do that is you protect the startups that you've invested in and your capital in those startups. So it's not, none of this is mean. Like this is just logical.
It's not about
I would have done the same thing.
It's short-sighted though, because all of these clients and their investors and these businesses, they're depositors at Silicon Valley Bank. So it's short-sighted. The implications for the Valley are probably bigger than any other implications.
So Gary Tan is the CEO of Y Combinator. He's like, this is an extinction level event for the startup industry, and it probably sets us back on innovation by 10 years. And there's related technologies. So we're talking like renewable energy, sustainable energy, certain things in the pharma world and innovations and anti-aging. There's lots of things that are going to take a big backwards, just a lull. And like specifically, like the easiest way to think about that is when we talk about startups, we're not meaning somebody with a couple $1 million. A lot of these are tech startups that are paying very, very mature technology teams to build very, very advanced technology, and they've raised 20 million, they've raised 50 million, and they're about to go out for their Series C or D. And now that ability to raise the next round, which would have been very predictable 2 years ago, or last year, or 2 weeks ago, is no longer even in the cards. They're not going to be able to go and raise Silicon Valley capital at the equity valuations that they needed to be sustainable as a business. So the actual model of investing in equity in tech before it's actually created the value, right? This is like the opposite of Warren Buffett. We're not buying tomatoes and railroad trains. Like these things don't have value yet until they're completed. And the whole model in Silicon Valley is betting on the future. And it had been commoditized, which lets the brokers in the middle, which is a series of lead generators, people who refer deals to the VCs hiring junior partners. These are all just different forms of brokering, including your banking relationships. There are so many brokers that have been in the middle of this betting on the future that we have a detachment from assets. 10% of the portfolio, 20 billion-ish, was in venture debt. Like, you only get repaid on the debt to ventures if they get to see through their product, get customers, and then repay you. So SVB got something like $500 million in profit in 2021 from venture debt returns. That was 100 billion. So it was like almost a fifth. It was like a quarter the next year in 2022. Their profitability on venture debt was tanking at the same time as government bonds are increasing. And then they announced this like, hey, we need to raise to have liquidity. And pretty much that one announcement made all the VCs who are protecting only their own interests. It's not an industry that looks out for each other. They just need to go, oh crap, get your money out, move it to JP Morgan or Bank of America or whatever you need to do. Just get your money out. It is such a small world, though. Everybody's in a Slack group together. I mean, these are just Zoom calls and Slack groups, and like, it is just 1,000 people on an email chain who are CEOs of these small, medium businesses.
Yeah, but I think you just made the perfect case for why this was short-sighted.
Hell yeah, it was. It was a house of cards. It was a house of cards.
Let me ask you a question. I actually don't know the answer to this. Is causing a bank run illegal? Is it a crime?
No,
it's not. Okay.
Well, I mean, it depends upon who's causing it and how they're causing it.
Well,
intentional market manipulation is, but this is not.
Yeah. So my question is that those. So from my understanding, there was a venture capital fund that told all of its the people in its bucket, hey, take your money out.
All of them were like, yeah, it's such a small world. They all said that.
Yeah.
And so whoever started that, are there any legal ramifications around that?
No, it's just the ramifications are that the ventures that they've backed are potentially illiquid. And that's the craziness. And again, like, I don't necessarily, I mean, I'm torn. I'm actually torn on what the Fed has done, because I don't necessarily think it's the worst thing that they could have done, because they came out, the hard parts, they came out and they said, we're going to cover SVB, and then Signature went, us too.
Us too. Oh yeah.
Yeah. Cover us too. The hard part for me is the broader implications of the nationalization of banking, because now they're saying that everybody's money is secure. And the reality is that everybody that had 250 was insured already anyways, right? So it's only the people that had over $250,000 in one single entity or one single institution that were at risk. So what are we talking about? We're talking about businesses, and generally savvy investors. And And
Right.
what we've just done is by essentially nationalizing the system is we've removed the responsibility from the institutions, the businesses, and the savvy investors to diversify their portfolios and to manage their own liquidity. This is not like, so that's the hard part
Right.
is it's like, yeah, I'm really happy that we're not going to see an economic tumble directly connected to all of Silicon Valley collapsing. That's good news. But what it also does is
TBD on that, but TBD.
TBD, but at least in the short run.
Right.
But in the long run, like there's some pretty significant implications for essentially removing the risk from banking. And now we're simply saying that, banking to me is no longer one of 11 sectors. It's a governmentized sector that's serving all other 10. And now we've removed all of the risk from the system. It's just, I don't know. I'm not in the stock market anymore, so I guess I don't really care. But if you're in the stock market, specifically in bank, I would get out, and I would get out fast, because I think we're going to see a bloodbath.
Okay. Question on that. That is going to be common knowledge. A lot of people are drawing that same conclusion right now who actually have money in the markets. A lot of people were already pulling out of the markets or just diversifying and going after conservative stuff. Banks would have been considered conservative like a week ago. Right? So a lot of people have already pulled out of, let's say high growth tech or crypto, and they would have already moved that money into the equity of banks. Right now, I didn't check what the markets are doing today, or if this is immediately upon opening, like are people moving money out of the public banks? What happens when investors pull out of publicly traded banks? Does that hurt their liquidity?
Absolutely.
Immediately. That's the liquidity. Is that like deposits? Do they just get to use that money just like they would deposits?
Yeah, I think so. I mean, I don't know the exact flow of that, but I think, I think it's viewed as a part of their balance sheet. But with the big banks, it's interesting because the big banks are because of the Dodd-Frank Act and the attempt to basically prevent a 2008 from ever happening again, the big banks are more liquid than ever. I mean, they got more cash than they've ever had because they have to.
Because they've been forced to keep it on books.
Yeah, they have to. There's Basel requirements and Basel 1, Basel. It gets like really nerdy, really fast stuff that I don't even fully understand myself. But they have to pass these stress tests that ultimately have forced them to hold tons and tons of cash. So I don't foresee the investors pulling from bank stocks as being the biggest concern. I think the bigger concern will be what happens to the regional banks.
Yep.
Because essentially now we're saying that regional banks are
scary.
And more broadly, like what happens, there's so many layers of implication here that don't even have anything to do with banking in general. Like nobody's talking about the crypto reality here.
Let's talk about it.
The crypto, and this, to me, I feel so validated because I've been saying for the last at least 3 years, like crypto is not an investable asset. It's not. It is way too volatile. I get better odds at a blackjack table. And until it gets regulated and until it gets all of the things that the crypto community hates, anybody talking about it getting, it's just not an investable asset. Well,
not great odds.
Here we are looking at systemic failure that was, I think, at least at large, they will find out was led by a crypto collapse. I think that the bigger collapse here was less about mortgage-backed securities and bond market, although that, definitely was a direct impact. But the fact that
at the same time. Yeah.
Well, but the crypto market lost 50% of its market cap in the last 6 months. So
the question becomes, Caleb, you have something to add to that?
Yeah, I was going to add that you just look at Silvergate Financial as well. That's predated even as Silicon Valley Bank. That was primarily crypto causing or being a huge factor in the run on that bank. And by the way, Dustin, I think title of this episode should be the tide's gone out and they're all swimming naked. Because a lot of these banks are sitting on huge unrealized losses on their balance sheets. So they're supposed to take these these marketable securities and mark to market every quarter. And what's happened is because of the rising interest rates, a lot of banks are sitting on estimated over 600 billion, probably more than that, of unrealized losses on these balance sheets, where if they have to sell those in the open market for liquidity, it's just not going to be there. It's going to be pennies in the dollar. And so it just, but I'd say Silvergate is indicative of the crypto as well.
And nobody said anything about that, by the way.
Yeah.
The media had nothing to say about that.
So I wanna play acronym COP or mark to market. So tell people what marked to the market means.
So in essence, it's just saying something is worth what it's really worth in the current market. If you're gonna resell that asset, what would that be worth in today's value? So how this works at a real simple level is, let's say I put $1 in a bank. That bank goes and takes a low yielding security, and the interest rates go up. Well, all of a sudden, that interest rate security that was maybe making 2% isn't worth much to an investor who wants to make 10%. So in order for that bank to give me back my dollar when I withdraw it, they have to go sell it, and it's only worth 60 cents. So there's a 40-cent gap there. So with
they
this,
take a loss on your dollar.
Exactly, they take a loss on the dollar, which is what happened to SVB, is they realized a loss of 1.8 billion. So they go and try and raise 2.2, which didn't get off the ground. So essentially, it's recognizing the assets for what they're truly worth if they were to go sell and liquidate in the current market dynamic. And a lot of these banks are sitting on huge amounts of assets that would be sold at a loss if they're forced to liquidate.
So
one of the weirdest something that's really interesting about that, and this kind of references to a conversation we had just a few days ago, is that even though we've been talking a lot about, startups, venture capital, we've been talking a lot about that sphere because that's the first one to be impacted. SVB is not the only bank that has this type of exposure because of the treasury bonds that they purchased. It's just the first one to go down because this group of investors got really nervous. And I think two things that I would say on that. Number one, I think this illustrates the dangers of a bank run in a social media age, because how did all of these people know that SVB was going to collapse soon? Well, or was at risk of it? It's because they're all on the same Slack channel. What happens when it goes on TikTok or when it goes on Instagram? And I don't think we've ever seen that kind of event yet. Can you imagine TikTok, Instagram, all these social connections having existed, in
That's
in
a
a
really
way.
good point.
I think that we have, and it also, another question is like how quickly we have access to our funds. I don't have to stand in line at a bank. I log in and I transfer money. And so there's the speed of information and the speed of moving those funds around.
Until your server's down.
And that's probably what would happen.
Bank, it's a server issue. Also, the money was on that server, so I wish it didn't go down.
I think you're spot on, because to me that was the biggest, and that's why I'm torn about the Fed decision, because the biggest economic risk, at least in the short term, was mass hysteria, the minor hysteria that was developed at SVB being reproduced into mass hysteria nationally. That was the biggest risk that I think they probably did a good job squelching, at least in the short term.
Yeah. Well, I have an example for that. So over the weekend, I shared an article with these guys that basically listed, the top 20 banks that had this same type of exposure as SVB based on these treasury bonds.
Oh, that was the Market Watch article?
That was the Market Watch article. Within 24 hours, that article's gone, scrubbed from their website. You can't find it.
Pulled down.
Now, for those that are curious, it can still be found on archive.org. So little pro tip, if that happens to any of you, so you go to archive.org. If you have saved the URL of the page, you can copy paste the URL into archive.org. And if it has crawled the site, then you can go back and view it. And that site on archive.org is still up. But that's an example of that. I think there are greater powers at play here that are trying to limit the risk of the greater market as a whole by culling this mass hysteria before it happens. And so the reality is, I think these banks are very much exposed. It's not just limited to SVB. And, we'll see what happens with that. I'm not advocating for bank runs, of course, but
dude, this this so the nationalization of our banking system is a big deal. It's hard to wrap our minds around what that really would play out to look like, because there's a lot of different pieces to that puzzle. Some of this will have to be, we have to pay attention and make the necessary adaptations for our own businesses as we go. And consumers are going to have to do the same. So knowing what's going on will be really important for the next weeks and months. But you're like, so you're making this point of social media has never been in this easy to transfer information state when we've gone through any type of collapse like this before. It's always been able to be somewhat controlled by a few big media outlets. And so typically you would get biased information, but you would get, carefully crafted information from two opposing sides politically, and some related groupings of media. Now it's just a free-for-all. Anybody with a microphone like ours can have a chat about this. And
if you want spicy geopolitics involved, not all of these social platforms are owned by the USA anymore. TikTok is a great example. And so the other part to this powder keg that I see is we've also never been in a situation where the biggest companies in the world and in America are tech businesses that were mainly in San Francisco. So if you were to look at just by market cap, public companies, we're talking about Google and Microsoft and Apple and Amazon and Netflix, and like now we're adding Ubers, and we're like on and on comes the list. Zoom, post-COVID became huge. The tech companies, Airbnb, they used to be like, oh, it's like a nice two-sided marketplace business. Oh, isn't that cute? Another guy became a billionaire. But I don't think we've put much thought into what happens when a lot of our GDP and a lot of our value as what we output as a country is not in banking or real estate or something with very, very concrete assets, but it's entirely speculative based on consumer behavior. Airbnb is valued based on the fact that we think you will go pay for another Airbnb next month, but it's not like a hotel chain that actually had the hotel under ownership. So when you value the two things, like one is actually based on its customer growth. Netflix subscribers is what that's valued based on. Amazon would be like a good hybrid. They have tons of infrastructure, but they also have speculative tech. So what is going to be interesting as we proceed is like these things are more correlated than people want to believe. That like Silicon Valley taking a hit, it means a lot of things for their job markets. It means a lot of things for those real estate markets. It means things for disruption and fear. Like investors, like those big companies are safe on their own merit. But there's a whole wave of companies that were about to be those big behemoths again. And those suddenly aren't going to reach that height. I think that it just changes the trajectory of this side of the nation. It's like New York and San Francisco. That's how we've been producing as America.
Yeah, I mean, I agree with that. I think that the simplified solution to a very complicated point is now is a really good time to be in hard assets. Like if you're thinking about this practically, like now is a very it's honestly as a real estate guy, like this honestly isn't the worst.
You're just giddy.
I'm like, like
you're just giddy.
And to be honest, like as a fundraiser, because I raise a lot of capital, I'm like, okay, it's time to call all the investors with their IRAs and 401ks. And you know what else is in trouble right now that ought to be talked about is pensions.
That's right.
Like pensions are in deep trouble. I am nervous for boomers. Like this, so there's a lot happening here. And I would say for anybody listening, if you don't understand all of the the implications or even the if you're swirling out on the possible outcomes, know this, it is a great time to be in hard assets, whether that's real estate, whether that's precious metals, whether that's, anything that you can hold on to. Now is a really, really good time to be in that space. And I think even a deeper level, like silver to me is like a really hot hard asset that has a low barrier to entry that people can reallocate a lot of their assets into and be in much better shape than what they're going to be in the next 12 months in the market. I think what this did, that I wasn't fully convinced of a recession, or like at least a broad stroke one. What I think that this did and the Fed's response to this was all but guarantee one. And I think it is going to be a little ugly. But yeah. I think the hard assets are going to be okay. I think, to your point, Kendall, the speculative, the intangibles, the pro forma based investing is going to really, really struggle.
Everybody's going to think twice. I mean, if it was hard to fundraise before because we were already in a slowing down market, at least in tech, now it's just going to be impossible. I mean, you're going to you're not going to get the valuations or the cash from outside investors or banks because they know, because you took it all for real estate. Like the other part is like now the lenders, they're not going to write loans to tech companies because that whole market was propped up from outside capital. So a lot of they're just not going to be convinced. So like, I don't know that you're a safe bet because in 2 years, like, we don't know if you'll be able to raise the whole time. So if you ever have to raise, it won't be there.
Which is exactly why they're going to get really bullish on anything hard asset.
Yes, they are.
They have to lend. They have to invest. Like the mechanism by which the banks make money is not going to change. They are going to convert cash into debt and they're going to lend it out. But what they lend it out on that buy box is going to shrink real fast and really aggressively.
So where they lend that money. Oh, and then Caleb, then I'll move to you. But where they lend that money tends to be the employers that, if you're listening to this, like, maybe you don't have money to buy hard assets, and Michael's just being an asshole trying to recommend that to somebody who doesn't have money. But like, if you don't have cash,
you just don't know how to do it without cash yet. I can help you.
Go watch Michael's channel. He can help you buy with no money down. You just have to be a good talker. So like, I would even be looking at your employment prospects as like, well, I was going to be in like AI, but now I'm going to go do AI stuff for a real estate investment firm, or I'm going to go help this construction company scale, or I'm going to go into the trades and be a part of this private equity company that is rolling up trade companies from boomers. Like, it doesn't have to be scary for people who are in the early part of their career. They just have to know where to go nest their employment and their skill set. And you just want to aim what you do at the place where money already exists. Don't be crazy enough to go try to create money in a place that doesn't exist. Just go capture the money that's there doing what you do.
Or do both.
Okay, Caleb, what were you going to say?
I was just going to circle back on what happened over yesterday regarding the bank term funding program. Basically, it's what was spun up and announced publicly yesterday, where the Fed is coming in and they are lending. We talked about those securities and those bonds, right? Are not worth $100. They're not worth, if they invest $1, they may be worth 50 cents right now, whatever the real value is. Well, the Fed's coming in and saying, hey, banks, we see you've got $1 trillion worth of bonds. We're going to loan you $1 trillion. We don't care if those are really worth 500 billion or 300 billion in the current market, but we're going to lend you 100% of the par value of the face value of that bond, not the real market value. As if you were to hold
them to maturity.
Exactly. Yeah, not what the real mark-to-market value is, and if you're going to sell it in a secondary market and experience a loss like SVB just did. So essentially, they're saying, look, we're going to lend against any collateral you have that is purchasable by the Federal Reserve in the open market. I'm looking at their term sheet right here off the Federal Reserve website. And so we're going to lend you 100% that value, and you basically can repay the loan at any point in a year, I believe it is. But then their recourse is going to be beyond that pledged collateral. So the Fed's saying, look, we can tip into any of your assets. We can claw back any of your other assets you have for repayment of this loan. But essentially what the Fed's doing is saying, look, we're going to ignore the fact that your bonds are not worth 100% of the value. Yeah. We're going to pay you as if they were. And I don't know, I hear many people talking about that.
So basically a bank can just get more upside down in this program, but it won't have a run on the bank, shut it down overnight.
Yeah, the loans have to apply to assets already owned as of March 12th. So they can't just go borrow a bunch of money and buy
it's
more of the
temporary.
same stuff. It's what do you already have on your books? And we're going to basically lend against the current assets on your books as a stopgap for the next year.
It's essentially all the regulators skirting the fact that they made bailing the banks out illegal. That's what, to me, it's
Smoke
like
and mirrors.
Yeah, this is
Yeah.
all just a fancy structure for a bailout.
Exactly.
Yeah.
And it furthers the concept of nationalizing the banking system. Whether we ever say it's that or not is less important than what's actually happening.
I would term it as a backdoor bailout. It's something that you don't hear about, but it's happening behind the scenes.
Yeah.
Oh, and
So what do you guys?
And the taxpayers aren't going to pay for it. Don't worry, the taxpayers are going to pay for it. Don't worry, the taxpayers aren't going to pay. What the hell are you guys talking about? Of course they are.
You know what? Everybody gets 2% off on their taxes this year. You're just going to pay 30% more in inflation. So, what do you guys think?
To that point, actually, before we move on, so I want to touch on this too. I know, Michael, you're really pushing hard assets, and I agree. And part of this, I just saw today that the Fed is talking about reversing the direction that they're going with interest rates. And so the latter half of this year, they're talking about bringing them back down. I think it was 75 basis points. At least that's what they're saying now. And so this whole direction that they've been going, they're turning that around so that this problem with the treasury bond issue, to try and bring it back under control. Now, if that's true and if that happens, then basically what that means is we're back in a lower interest rate environment than we are today, and that means more inflation, which is great if you hold assets. It's great
or
if you
terrible
hold assets,
if you buy a lot of coffee.
Terrible for everyone else. Yeah.
Yeah.
And so
this is a really, really, really good point, and I'm glad you brought it up, because a couple of things. There's some pros and cons to this implication. The implication here. See, the Fed was going to raise the rates. Powell's going to raise the rates again in April, probably. So the only thing we know for sure is that's not happening, which is great news, right? And there is the possibility that they drop rates. And honestly, I think we all, like anybody who's got a half a brain, knows that they were probably going to drop the rates sometime around Q4, Q1 next year, so that Biden can say he killed inflation and dropped rates and, hedge his election. But what this does, the implication of this, that I think is really interesting, is that the fact that this has now happened, what I think they've done is they've been able to pressure test the rate market, and now they know they don't ever have to bring them back down close to zero. And so I do think this does is I do think this shortens the gap, because there was a lot of people hoping that the rates would come back down into the fours, and I don't think we will ever see anything sub 5 again. And I think what's happening here proves that, because they've been able to pressure check. And I don't know that that was a direct intention, but that they're sitting behind closed doors going, okay, this is as far as we can push it. And so for all people that are looking to buy homes, that are looking to borrow, to do these things, like you can know that we're not going back to the promised land of interest rates. That's for sure.
Dustin, what was your interest rate on your house in Reading?
Sitting right around 3%. Plus or minus.
Do you think I could buy that for, I pay you 110 cents on the dollar for your mortgage. I want the house, and I'll pay your mortgage.
One of ours is 2.99.
Oh, that's great.
I just
snuck right in under that 3% mark.
I just paid $75,000 over fair market value for a rental, because I took over their 3% debt,
their mortgage,
and I got their balance and equity owner financed at 0%.
That's awesome.
And that's why you should follow at Dead Presidents Club.
That's right.
And that's what Michael teaches you to do. So now that we got that shameless plug out of the way, I want to ask you guys, I don't like getting overly political. I don't even know where you guys are at on the spectrum of politics, but it is an election year now. And this is a big deal for an election year. This wasn't going to be nearly the topic that it suddenly is. So what does this mean that we're going to see people running on? Like we might not be able to predict that perfectly, but it's not hard to imagine how both sides are going to respond to this.
I mean, I don't think we can predict it perfectly, but I think we can make some pretty solid assumptions here. I think if anything, this probably hedged up the two-sided narrative pretty guaranteed.
It firmed it up.
Yeah, I mean, Biden is going to say, look at all. I mean, you already saw that in his speech. You know, the lowest unemployment of any U.S. president for the longest period of time, and he's already starting the narrative about the Biden economy, which is laughable.
The Biden economy.
The Biden economy is a disaster. So that's
Bidenomics.
You know, so he's already starting that narrative, or at least the people that control the cyborg are starting that narrative. You know, the GOP candidate, which appears to be Trump, will obviously do what Trump does and make Biden the biggest idiot, and that, you know, he single-handedly caused the bank run.
SBF and what is it? SBF.
Sam Bankman-Fried.
SVB.
Yeah, and SVB. It's just one letter changed.
Yeah, all the
the
B's
same
are
thing
going to
to Trump.
B's are going to stand for Biden in the marketing that Trump does.
Silicon Sam Biden Bankfried.
Sam Biden Fried. I mean,
Sam
Biden's
Biden
bank
Fried.
run. Biden's bank
Oh,
runs.
Man, you guys
Biden's
should write
bank
for
run.
him.
You
should
heard it
write
right
for the
there. I like
campaign.
that one. Biden's
right.
bank run. We're going to see
Biden's
that.
bank run. Biden's Bankman Fried run.
Yeah. I mean, I don't know. I mean, obviously, like, I'm an investor, I'm a capitalist. So like, I'm fiscally conservative, hate him, love him, don't care about him. Obviously I think that a Trump economy is a better economy. I mean, we saw that pretty clearly. I think Biden will try to say that Trump is responsible for this bank collapse because he was the one that loosened the bank regulations on small.
Already has. They've already. I think I've already seen
again.
those arguments.
Yeah,
Biden won't be the candidate with that. Like, there's no way. There's no.
Oh,
way
for
Biden
sure he will be.
candidate.
What do you mean he won't be the candidate?
No. It's not going to happen.
No, I agree with Michael on this. That's the only way that you can beat a person like Trump. You have to be the incumbent. It's just the only
There's
way.
there's no scenario by which
They're
Biden
not going to pull a left-leaning Trump type out to fight Trump.
No, they'll
they
automatically
can't.
lose in that scenario.
They can't because they already tried that. See, here's what I think politically, if we're going down this path, I think that they already tried that with Hillary, because the better candidate for them in 2016 was Colonel Sanders, and so the
chicken daddy,
Bernie Sanders,
Bernie.
Yeah.
I think that if the DNC would have stayed to their commitment to Bernie would have beat Trump, because Bernie had the ear of the millennials, and so I think that they got burnt by their decision to, because they essentially kicked Bernie out of the race in favor of Hillary, thinking that Hillary could bulldog her way against Trump, and they quickly found out that was a bad move. And
she was shorter and lighter weight, and so two bulldogs fighting with one smaller. I picked the bigger one.
Yeah, and they were both male too. It was weird. And so I don't see any the DNCs. They're not going to do that. They're not going to make that mistake twice. So, and the fact that taking all the elections were stolen debates out of the equation, the fact that Biden beat Trump, even with the how silly those debates were and how silly the landscape was, is a strong play for the DNC to keep him in place.
Got it.
If you think Biden beat Trump.
If you think Biden beat Trump.
Just got to throw that out there for all of our listeners.
Well, those servers can crash too. I mean, Wells Fargo doesn't have to make their deposits to employees, and we don't have to count every vote. It's fine. That's just all on the cloud, guys. The cloud has got our backs. Yeah. And AI is coming for your jobs.
I like it.
So I think what it does too, at least for the Democratic platform, traditionally the Democratic platform is more about regulation and the conservative platform is less. And so this is a prime hotbed of narrative to say, well, under regulation causes this problem. We need more regulation. And that's ammunition that I think the left is probably going to use, to pretty decent effect in their campaigns. But then you've got Trump on the other side, and I'm calling it. It's going to be bank run Biden. That's going to be his
He's
pen
gonna
name.
say that.
Bank run Biden.
You should
that's
tweet it at him. Tweet him at it.
Yeah.
Tweet it at him,
Yep.
and that's a guarantee.
There you go,
So-
Trump.
So I want to go back. I want to go back to something. Elon buys Twitter.
Oh yeah, I love this.
Elon buys Twitter, and come to find out, you can lay off 4,000 of the 5,000 employees or whatever it was, and I can still tweet. I can still send. I can still reply. I can still do threading. I can still tag people. The servers didn't melt, and the average. So most people don't know this. I'm in this community called Blind. You guys could lie your way to get into this community if you want. Download this app called Blind, and you basically get to watch the anonymous banter about salary and compensation from FANG, Facebook, Amazon, Apple, Netflix, and Google. Well, Twitter happens to be a very closely related company to that group. And so it is very common to say somebody like, hey, I just got laid off from Twitter because Elon is the Elon monster. My total comp is $320K a year, and I had $100K in bonuses. And I'm just wondering if I would get a better deal at Amazon or Netflix. And that's what this community, I'm watching this in real time. I watch it every week.
And this is all anonymous? Is that what it is?
It's all anonymous. Yep.
Okay.
And it's called Blind for a reason. But people sign off with TC : and then they enter a number. That's total comp. So I watched the Silicon Valley salaries for the average engineer. Like I run an engineering company. I know how much it costs us for code. They pay about triple on average to what I pay for code.
Wow.
And they do it because they're behemoths. They do it more bureaucratically, so they're slower. There's more layers of management. And I understand why Elon can cut 75% of the salaries, and these are big salaries, and still have an effective company. That is not true if you're running Colonel Sanders' chicken franchise. If you are investing in Warren Buffett's railroad ways, or you're building real estate in New York, that's not true. You can't cut 3/4 of the overhead. In Silicon Valley alone, can you just axe 3/4 of your overhead and still have a working asset? Now, asset, people will fight me on the definition of asset, but like being in tech, there should be, we probably need better language for this, but there are things that are more like an asset, that organic search, server infrastructure, backlinks to a bunch of other credible like companies, even like your team can be an asset, because the efficiency of this group of people working on this problem is a tangible thing that is for hire. Anybody could hire this thing and it would create that thing. So the asset Silicon Valley has been banking on is essentially their brand and their teams. And now we're going, well, we're just watching in front of our eyes that melt. That's not a real asset. That's not a real asset. And it can go to zero.
So
what's interesting is the business will remain. So the brands will remain, the tech will remain. It will bounce back. It's going to get weird.
No, the brand won't remain. Not for the bank.
No. So I'm talking about tech. If tech value gets wiped out,
sure,
their market values can wiped out. You can lay off the teams. Twitter remains. Sure. Twitter's service to customers remain.
Well, this monologue became far more disappointing to me than I expected, because when you said Elon Musk and Twitter, I thought you were going to talk about him expressing interest in buying SVB. And
did he say that?
Yes, he said he'd buy it and make it a digital bank. And I was honestly, I would have put all my money in that bank.
I didn't know that's a thing.
You've been told. That's it. I mean, clearly
that's all you know.
Clearly they weren't able to broker a deal, because I don't know if you guys knew this or picked up this part. So they were able to sell off their British assets. So I think it was HSBC.
HSBC. Yep.
Yeah, HSBC bought like all their European assets, or most of them at least, for like £1, which is a very countrywide Bank of America type deal. But probably probably some upside there, but I imagine there was more backdoor forcing than there was a desire on HSBC's part. But they weren't able to find a buyer in the US. So that tells me that Elon either wasn't as serious as he tweeted, or the deal would not have been favorable for the regulators. So, and to be honest, like I said, like I think that there's very, very, very likely conversations happening about how they privatize this whole, or how they government, nationalize this whole thing. And so, it's not in their interest probably to sell a failed bank to somebody like an Elon.
No, you would lose your catalyst of all the politically, this crisis is going to be a rallying cry, right? Of, hey, how do we come to the rescue? The capitalists have doomed our economy, right? There has been a bunch of shady stuff happening, but how to have a political solution to an economic problem is often going to be the rallying cry. So to basically punt that and lose an opportunity would be a big political misstep, I feel, for the left.
I agree.
So now, what are the implications of a nationalized banking service for the regular, everyday person?
Michael, you go first on that one.
I mean, I think the biggest one is just going to be the loss of an entire investable industry, right? Banks historically have been a huge asset class to invest in, and if this happens that way, or even a version of that they don't call that, it's going to make banks it's going to make profitability for banks insanely difficult, making them less sexy as an investment vehicle. So I think that's a big one on the investor side. I think that there's political implications. If the government truly controls the money, then we're not very far away from the government controlling everything else, or at least socializing it. Which essentially is what happened. Like, that's a better word than nationalize. I think what they did over the weekend is they socialized the bailout. Is they basically took everybody's protection and gave it to the few that were in danger. And so they socialized that risk. So I think that, he who, I forget who coined the phrase, but he who makes the gold makes the rules, right? That's the golden rule. And I think that he who controls the gold, if it's the government, controls the rules. And so I think that that's a very strong danger towards a socialistic.
It's a geopolitical danger.
Yeah. And then beyond that, I mean, you've got just the messiness, I think, of like there being no point to regional banks at that stage, right? Either centralize the big four, or you combine to one and figure out how. I don't even know how that would happen, but you figure out that whole thing, and they're really all of the employees, all of the depositors, all of the assets, like all of the stuff that happens in local economies with regional banks and city banks, is in deep jeopardy. So I think those are the off the top of my head implications.
So what happens in the process of the equity getting wiped out in banks as an investable asset class? And at the same time, regional banks, their value falling for their owners and shareholders too.
Well, I think it's unlikely that they just wipe the asset value or the equity value outside of what happened.
No, the markets will do it for them. We're not going to invest in it. So then
the government would buy those positions, I would think. I would think that.
Yeah, got it.
Because that's essentially what they are.
No.
That's essentially what they're doing right now. They're taking regulator money.
That's too overt. I don't think that will overtly happen. Covertly, I'm on the same page.
Is it not overtly happening with SVB right now?
For the failing ones, but in this process of questioning the very role of regional banks and somewhat sophisticated investors going, why would I invest in a bank ever again with all this mess going on?
Well, I think to your point, what will the sequence of events will be more failures. So they'll force failures because they haven't said that all banks' deposits are protected, but they've said it by making.
They set the precedent.
Yeah, they set the precedence, which means that they're going to be legally and optically on the hook for future failures. And so I think it will be a slow burn over time, and then whoever the reigning, voice is for that move will go, "Hey guys, let's stop letting banks fail and let's let the government step in," as if the government's any good at creating or managing money at all.
Yeah.
Well, and you got to keep in mind too that there's degrees of. I mean, the government's already. You look at the mortgage industry, right, and how many loans are FHA insured or resold, Fannie and Freddie. All the markets there, and even the regulatory environment is that there's just degrees of influence. And I mean, you already have, in my mind, financial capture within government, but governmental integration already in the financial systems. So it just feels like this is just one more interweaving of two components of our society that are already really closely linked. I mean, I think there's a lot more influence than us everyday folks even see on the surface, between banking and government.
What are your guys' thoughts on cash? Like how this affects fiat?
I think with the basis points being dropped, I think inflation's going to continue to occur. And I just think the value of cash is going to go down, personally.
But you're going to need cash to get those assets in general. So we're in this weird tension between these two realities of your dollar's getting diluted as the longer you hold on to it. But right now you got to pull out of things that aren't, you got to pull out of most things that you traditionally would have invested in. And real estate's going to be weird to watch. Like, is the average home and multifamily complex and commercial property going to continue to grow while other things are tanking? That's going to be really interesting.
Well, hold on. You've got to break that off, because you just said is the residential, the multifamily, and the commercial. Those are three very different segments of the market. Commercial and big multifamily is about to face a major problem because of the cost of funds. So unlike
right.
a residential purchase that has a 30-year fixed interest rate, most of these bridge loans that these guys
they're not backed by Freddie and Fannie.
Well, they're not backed by the government, but more importantly, they're generally on 3, 5, 7-year terms. So all of this money that they got at 2 or 3% for 7 years, the issue isn't going to be that the rates are too high. The issue, or that new buyers can't get the rates. The issue is going to be that the new buyers can't pay the elevated price with the elevated rates. And so all of these investors, especially the big firms that have bought big blocks of commercial and large multifamily, are going to have value punches really, really that I've heard economists refer to it as an upcoming bloodbath in the commercial and big multifamily space. And we're already seeing that with the firms, because they're already doing capital calls because they're worried that they're not going to have enough cash to essentially weather the transition. Scary. So I think the commercial space is a totally different animal in this equation than the residential space. The residential space has got 30-year fixed money. It's got the lowest inventory since, pre-08. Like we're just now getting back to normal, I would say. And so to Andrew's point, like what happens with inflation is going to be really, really interesting for those of us that hold a lot of either small multifamily or single family residence.
I've got two comments on that too. I mean, the liquidity, right? The availability and the speed and the cost of money really impacts real estate. And so I'm curious how the volatility in the banking system in the coming months is going to impact demand or interest in lending, and how it's going to impact availability of financing for everyday mom and pop refinances and purchases. So that's a big thing to watch. And personally, I'd like to have some cash on the side and see what happens with real estate. Looking back in 2008, you saw there was some of the best buys were several years after. So I'm curious to kind of watch that trend. Yeah. But the second thing to that is also, in September 16th, 2022, the White House did come out with a statement, a press release around the technical possibilities for a U.S. central bank digital currency. And a lot of different countries have been talking about going to a digital currency with their central banking system. So in my mind, could this bank run crisis and the coming political
I can
solutions
absolutely get
that'll
there,
come
yeah.
out. Could this be a maybe shorten the gap on rolling out a massive change, which is a central, a digital central bank currency system, which, oh my gosh, talk about the ultimate control. If eventually, if our ability to purchase, if our net worth, et cetera, were digits in a server somewhere, I mean, the ability to have influence in society is pretty unprecedented. So I'm curious how this might potentially speed up some of those conversations about, is a digital centralized currency a viability for the US dollar?
I mean, I
I mean,
think.
if you're,
Go ahead.
if I was just going to make a statement, like depending on how much tinfoil you are wearing at the moment, like maybe it was the plan.
Yeah.
I'm not spreading
Well,
false information but
I don't
like
know if
that.
I don't know if it's so much the plan as much as it is, because here's what's going to happen. The Fed has been and will continue to print these dollars at the fastest rate humanly possible to try to slow down our rush towards a recession. And so the Fed is, I don't know if the Fed has motive for centralized currency. I don't know. I haven't heard a good enough argument for that yet. But what I could see is that if we're going to regulate the banks, then now would be the time that we regulate crypto. Now would be the time that we regulate the digital market and we create a digital banking system more than a digital bank or centralized digital bank. And I do think that excites me as an investor, because now I get really excited about things like Bitcoin, right? I get really excited about like things that have, or even the more obscure utility currencies, like they start to have real potential, because the quantity based ones, or the quantity limited ones, I believe, start to have real potential to, maybe not eliminate fiat, but re-centralize it against an asset. And that would be a really interesting thing, but that would have to come through regulation. I also want to know why Dustin looks like he's falling asleep. It's like, do you hate the economy?
I can see it behind his eyes. The reason Dustin is just figuring out how to make money off of this. So Dustin, why don't you tell us what you would do in this environment to go hustle somebody?
That's really funny. I was literally just on my phone looking up, okay, how do I set up an affiliate link for selling silver? Because people are going to do this, and I want to get on the chain.
There you go. Get on the chain.
That's pretty damn impressive, Kendall.
I honestly, I think like our listeners, I know this is different for Michael's listeners, but like our listeners should be taking notes on which industries are, this is basically how I work backwards from it. Which industries are taking the lion's share of easy money? There's two types of money in the world, easy money and hard money. And the easy stuff is shifting right now. That's what we've been talking about. Well, you can go through the companies and the types of companies in those industries and just look at the titles. I like to browse LinkedIn for people's jobs and just read a little bit. Go look at like HR's job listing. Like, what does that job do? And figure out, oh, that guy's pain point is going to be like, I need to get more traffic for my silver buyers. And I'm going to send that guy a cold message right now and be like, hey, I happen to do marketing for silver buyers. You want to talk about it? Like, there's a lot of simple ways to make money when you can go provide service as a young, slightly technical entrepreneur to the people with money who can't do what you can do.
You want to know an easier way I think you can make money, Dustin, or anybody, is become a master matchmaker of capital. I think right now, more than any time, at least in the last decade or more, the access to the ability to raise capital for good investments is going to be massive. And so you can get paid pretty handsomely as a capital matchmaker. I've paid people, tens of thousands of dollars for literally making an introduction to an investor who funds a deal for me. And all they had to do is say, hey, Uncle Bob's got, $1 million in his IRA. He doesn't want in the market anymore. You want to talk to him about any deals you're thinking about? And if that turns into an investor that funds a deal, I pay essentially, we call it a success fee. We pay a finder's fee for being a capital matchmaker. And I think that, Kendall, I think you're spot on, but for those people that are listening that go, I don't know how to do that yet. Like, I haven't figured out how to solve those problems for people and monetize that problem solving. Gosh, just find the guys that know how to solve those problems and match them with the Uncle Bobs of the world that don't know where to put their money.
Recruiting as an industry is easier than people think it is. It's matchmaking talent, right? And in a time like this, like what you're talking about is essentially matchmaking the same thing. It's a person on both sides who want to meet. They want to know each other. And the process is very simple. You talk to one and you say, I matchmake for XYZ thing. And you tell me what your requirements are and I go hunt it down. And it's very manual. And here's my fee. And like recruiters are paid $50,000 to headhunt an executive. It's very, very doable to become a recruiter and then switch your industry based on the current events while everybody else is waiting to see.
I just got offered it's a big deal. It's a big development deal. I just got offered close to $500,000 plus 10% equity in $124 million development to be the matchmaker for a $6 million 6-month bridge loan. So I had to find the $6 million. I get a $500,000 payday and 10% of essentially a $40 million profit in 6 years. And all I have to do is make the match. So what am I out doing? Calling everybody I know.
Calling everybody.
Capital, so
we should talk
ironically,
after this, actually. This is
ironically, you could give half of that 10% of the 40 million away to the investor, just sweeten the pot.
So it was actually 20%, and I was using the 10% as as an additional incentive.
Oh, you were already doing it. I got you. Same page. So, there's other ways to make money from this. So if you guys can think of some that, again, like our show is for the people who are not running businesses already there, unless they're their own, or maybe they're running 5 of their own little businesses, or they're running a 10-person business. But this is, there's a lot of ways to skin the cat here, but you have to know what's about to slow down to figure out that, cat vasectomies are no longer going to be in.
But what about premier doggy breeding?
Yeah.
Shout out previous episode.
Yeah, there's a whole body of work on that.
Well, this was fun, guys. I don't think we solved anything, which was the goal, right?
No. And then there's the ethics of should we have shared the information? Is it better for people just to be blissfully ignorant? Is that better for the economy?
No, it's way worse because ignorance equals fear for most people.
Blissfully ignorant. I prefaced it with bliss.
That's just true. You did say blissfully.
People want to make sense of the world around them. And so if you can give people an explanation that makes sense, it helps quell fear, I think.
Yeah, but would the bank run have happened if people knew that they needed to have a bank run?
Whoa. Okay, should we end with an unqualified agree or disagree?
Yeah, sure.
No explanation possible?
No explanation
no defending
possible.
Your positions? Just yay or nay?
Yay or nay. All right. Agree or disagree. This is the same thing as 2008. Disagree. Or at least close to it. Caleb.
I would say, okay, I guess, yay. It's different, but it's big. Yay.
Agree. Okay. Dustin.
Disagree.
Andrew.
I can't be so binary. I would say if I could only choose one. Disagree in essence of what it is. Agree from...
That's a qualification. You don't get that.
Okay, fine. Disagree.
Agree. I disagree. I do not think that this is... I wholeheartedly disagree. Another one. Joe Biden is a cyborg. Agree, disagree?
Disagree. I can pinch his cheeks.
Have you? Do you know that?
I'm just saying I can.
Now, if you had asked Joe Biden is an AI deep fake, then this answer might be different. But for the cyborg question, I'll hit disagree.
Okay. All right.
Yes.
I think we all disagree.
Yeah.
All right. The best thing to do right now is to pull your money from the banks, from your bank. Agree, disagree.
And put it where?
What bank are you in?
Yeah,
Doesn't
where
matter.
did I move it?
Doesn't matter. You got to get it out of the bank. That's the best move. That's the best next move.
No, disagree.
Disagree. I would spread it though, so I have less than a quarter
I would get
million.
4 banks.
Yeah,
Exactly.
If you have less than 250,000, disagree.
I kind of
if you
agree,
have more,
actually.
then agree.
Michael, I agree with you. You should get it out of the bank.
You do agree. Okay.
Yeah,
I
put it in
disagree.
assets.
Now, okay, but that's qualifying. That's going on Kendall's track.
Oh, whoopsie daisy.
Because I think, then this will be my last agree, disagree. Cash is trash.
No, disagree.
Disagree.
I would want cash right now while I wait to pounce.
Andrew?
Andrew's like, just pay me in a percentage of that house.
Yeah, if you compare cash to real estate and assets, then agree. You compare it to the stock market, disagree.
That's not the question.
But I'm qualifying.
Cash
I'm
as an
qualifying.
asset. Cash as an asset.
As an asset, is trash. Agree. Okay. Agree.
Yeah. All right. Well, then my closing comment will be cash is trash. I agree. I believe it's just a bunch of dead presidents. Shout out.
Oh, baited. And
That was pretty good.
hey guys, my payroll company from last year didn't process their payroll Rippling. I got out last year and switched to a different provider, but Rippling didn't make payroll this week to their clients.
Really?
Yeah.
Not
That's
to their
wow.
employees, for their clients, which
If
was
only
us
that was
a year
illegal. Oh wait.
There's,
which is illegal in California.
Yeah.
Yeah, it's interesting times. More to come. Thank you guys for your time.
This was fun.
all right. Thank you guys.
Kisses and hugs.